many others. And as you can see, I'm one of the few guys in a suit right now. And it's not that I enjoy that kind of outfit like on daily basis, but it's rather right now we are entering the phase of our industry where we have to also like be as professional as the people we want to cater to. Like we cannot be anymore either children or like just frog PvPs on X or Twitter. Like we have to stand up to the level of those finance guys. So a few words about Redstone itself. We've been around for over 4 years, right now actually 5. We have never ever had a single mispricing or downtime event as an Oracle, which is not so common. Majority of our competitors, including the big boys, did have smaller hiccups. And usually an Oracle failure comes with like a very bad consequences. Bad debt, wrongful liquidations, protocols going down, users being extremely unhappy with how their positions are treated, unfair. Some of our partners are, for example, Securitize that chose Redstone deliberately as the main and official oracle for all the tokenized funds, including BlackRock Biddle, Apollo, Acred, Hamilton Lane Scope, and many, many others. When I was going through the due diligence from BlackRock, that was like an experience, I can tell you. Those people are extremely, extremely careful who they are working with. We are the first Oracle that launched on the Canton network. We are featured up over there, a validator, and we expand day to day within that particular ecosystem. We power Morpho, Spark, Camino. Right now, there is hardly any protocol in DeFi that is not necessarily like using Redstone. We're live on over 100 chains, over 200 clients trust us day to day. We protect north of $6 billion still in that bear market, and deliver price feeds for over 1,000 assets. All right, so Redstone is an oracle, it's growing, but why risk ratings? So last year in September, we announced that we acquired an entity called Credora Network. And with that acquisition, we decided to expand within this risk aspect. The reason we did it is in order to produce high quality ratings, you do need to have extremely accurate and diverse data feeds. And that is what we've been doing for a couple of years already on the Redstone side. Before we did that acquisition, we asked ourselves, okay, but how does the history of the ratings industry look like? Because you then can look for similarities. So it started in very late 19th, beginning of 20th century, where S&P and Moody's came into existence. But being frank, when I was digging into some historical data, no one cared. So it was pretty similar as it is right now in DeFi. In the very beginning, very little investors were actually paying attention to those ratings. But then the inflection point came in 1936 when the banks had the obligation to invest only into assets that were investment grade, which meant that on a scale from D to A, from specific trusted and recognized risk ratings agency, they could only invest in products that were BBB plus or higher, which were called investment grade. Anything below was called high yield or junk, and they couldn't interact with that. And that was the moment that the rating industry like properly took off. Then in the 70s, everyone already knew about when you're launching an investment product, you really need to get a rating in place for gaining investor trust, especially in the early days, or to scale to hundreds of millions and billions of dollars. But I bet you all saw The Big Short that in 2008 illustrated the, maybe not the collapse, but the huge hiccup of the financial market, where ratings agencies also played like a significant role, not necessarily doing their job in terms of the quality of the ratings they were assigning. And in 2020, we've seen the DeFi summer, right? Like the various flavors of swaps from sushi, pancake, or any other food that was appealing to the users. And now in 2026, we see the financial institutionalization of the industry. And whenever I talk with the big bank financial manager or like an asset allocator, they do ask, okay, but what is the rating of that product that I'm about to deploy my capital into? So this is a kind of area that we want to tackle. Vitalik posted in September last year that low-risk DeFi can be for Ethereum what search was for Google. And there are two concepts here. One is low-risk DeFi, and the other one that we promote is risk-aware DeFi, which essentially means to attach next to APY, so the earning that you can get the risk associated with specific implementation. For Vitalik, investing mainly in the low-risk asset was the key. But in our review, you can still invest in something that yields you 25% or 20%, but you should be aware that, for example, if it has C rating, there's a high probability of default. So it's not about taking away higher yield and higher risk assets. It's just making the users aware what they are signing up for when they are deploying the capital. And in order not to just put blank words over there, I'm going to bring 3 cases. The first one, anyone recognizes that chart? Anyone can say what it is? It went from 1.26 to almost 0 like immediately overnight. It was Stream Finance that blew up last year. It turned out that the protocol was missing 93, as far as I remember, $1 million, and their backing, and everyone who had essentially the stable coin of theirs that was supposedly worth $1.26, sorry, turned out to be worthless. And it's not a bad luck. Like I've heard people saying this event was a black swan or a bad luck. No, this is like one of the worst sentences you can say, because there was so many signs that this protocol will eventually collapse. And we as Credora, unfortunately, went live with ratings in November 7th, and that happened November 3rd. But reactively, we gave it C-, which is the lowest rating we've done like in the history, because just all the fundamentals were extremely shaky over there. And there's another chart I can show you that is way more recent. It's from the last weekend, which is Resolve, a stablecoin that got hacked. And an unauthorized party minted $80 million of additional stablecoins against the collateral that was sitting in the protocol. In that case, risk ratings can be helpful, because we did rate USR as a platform, but it wasn't a risk of the strategy that they were running. It was rather like a hack. So it can be helpful to navigate, but it's not solving the problem entirely. But still, it's definitely better than status quo with no any indication of the risk. So the problem statement is that it's difficult to choose the right asset. Lending markets involved for risk appetite of DeFi users. And we are only going to have more and more headache, because we see the evolution of stablecoins. We started with USDC, USDT, then we went through all the flavors of yield-bearing synthetic stablecoins, Ethena USD, Ondo USDY, Hashnode USYC. Right now we have over 200 stablecoins, and we are still living in this stablecoin year. I'm going to expect only more. The proliferation of real-world assets, whereas we started with treasury bills, we expanded to private credit, and now on daily basis I have discussions about trade finance, refactoring, reinsurance. Naturally, we see stocks being tokenized. And in DeFi, we also started with simple lending, lend and borrow, on Aave, Compound, Spark. Then we expanded into permissionless vaults with Morpho, Euler, and Camino. Now there is over 500 vaults and yield strategies that users have to navigate through. So the matrix is going to get only more and more complicated. So what you require is something simple for regular users. If we go mainstream and to institutions that are not native to crypto, something that is going to translate to them very easily the risk and the data associated with it from the market. That's a screenshot I took last week from Larry Fink. So BlackRock is betting billions that tokenized funds will do for Wall Street what the internet did to mail. If those biggest financial institutions and hedge funds say so, it's going to happen. So it's not about if, it's rather about when and at what velocity. And this is what we want to help. 2 weeks ago, I was in Washington, D.C. at DC Blockchain Summit, where I witnessed the chairman of Securities Exchange Commission and the chairman of CFTC speaking both at the same panel, talking about the memorandum of understanding they signed and supporting the crypto expansion in America. This is the first time we witnessed that. Historically, with Gary Gensler as a chair, it was very hard to do those kind of like crypto revolution. So all the pieces are putting it all together for the industry to properly take off. So Credora simplifies complex constructs into understandable information and provides simple to grasp risk rating. So you can think of it as a thermometer. If you like it hot, and sit on a chair that is potentially putting you on fire. You can go more towards the more risky asset. Naturally, it's more exciting, but it can come with a drawback. And then if you go on the safer side, you're less exposed to risk, but also probably the returns are more conservative. The scale, when we were thinking about how to approach it, we took the best aspects from the traditional market. So we mapped out the TradFi scale from AAA, BB, C, and so on. So a very difficult and very granular scale that evolved over time and made it way simpler between D to A+. And the main metric that we look into is something that we call probability of significant loss. This is defining the cutoffs for specific ratings to be assigned. And what comes into the rating are network risk. So the same two assets, let's call it Syrup USDC from Maple, can get a different rating on very popular network like Ethereum and an obscure L2 or obscure L1. Counterparty risk, smart contract risk, operational risk, who is the custodian, what is the legal setup, oracle risk, whether the vault has a hard-coded oracle, fundamental oracle, market oracle, is it an oracle that is trusted in general in the ecosystem? And the key indicator, as I mentioned, is PSL that measures likelihood of a market experiencing bad debt exceeding 1% of principal. And bad debt essentially means that there is a position in a vault or lending market that liquidators are not incentivized to close, so it's unhealthy. On Credora, I believe, key beneficiary in terms of competitors is that we rate not only asset, but also markets and vaults. Hardly anyone nowadays in crypto just holds an asset, like holds Ethereum, USDE. No, people usually loop it. Go to Morpho, go to Aave, and try to create a leverage strategy. So it doesn't tell you the whole picture if you just rate an asset. You should also look at the protocol level. What's the liquidity related to a particular asset? What is potential risk for liquidation, and what are the paths? So in the asset methodology, we first look into the category. So looking at the asset, is it a derivative token, like for example, liquid staking token? Is it a stable coin? Then if it's a stable coin, is it non-yield bearing or yield bearing? Is it an RWA, so a tokenized asset like treasury bill, private credit, and so on? Then we implement modifications, which is anchor probability of default. So we look into audits. How many are there? Like, are there from reputable parties? Were they repeated? Were they added when new code was released? Asset quality that is within a particular wrapper. What's the custody risk? Is the custodian from the trusted set of parties? And if the strategy is actively trading. So it's way different when you just deposit assets into one strategy and it's over there over time, or if it's actively traded strategy like the one with Stream Finance was, like where people were trying to do basis trade on leverage. And then we have modifiers, looking at reserve management, so things that happened over the past. So recent incidents, was there any DPEG? Was there a problem with redemption? What is the peg record? So an example whether a stablecoin lost peg for some time, what's the governance strategy? And then mixing all those aspects all together, we get the final probability of default that gives you a rating for a specific asset. So this is the first step we are doing. Then, okay, so imagine we have an asset, for example, Syrup USDC from Maple. I can tell you it has an A- rating. And then we can have USDC Circle stablecoin that has A rating. So we have those two assets, and then we can have a look at the market on Morpho, for example, looping of Syrup USDC to USDC. So in that particular case, we were going to look at loan-to-value thresholds, and also what is the bonus for liquidators should the position be underwater to liquidate that position, close it as fast as possible, and keep the market healthy. And oracle characterization, as I mentioned, is it the market oracle, is it hard-coded? We look into allocations distribution, so determining how aggressive specific active user borrow positions are. So are they very close to liquidation threshold? So if liquidation threshold is 70%, are they close to it, like for example 65%, or are they like only on the 20%? What's the rebalance profile? So we model borrower behavior from the past. So we look if they got closer to liquidation threshold. So imagine they started with 20% and they get closer to 60, whether they reallocated again into that position to make their health factor improve. What's the collateral asset rating? So what I mentioned, for example, Syrup USDC, whether it's a good rating or not necessarily like the favorable one. Rewards distribution, so we model what's the returns distribution considering the volatility and extreme tile events, and par liquidity data. So imagine there's the liquidation between the pair of Syrup USDC, then we look what's the situation on DEXs and CEXs in order to liquidate that particular pair. For example, with RWAs, this is something very common right now, that the liquidity is almost non-existent. So if there's a larger position to be liquidated, no one exactly knows how it's going to be performed. For price simulations, we implement something that's called Monte Carlo simulation. You can imagine rolling a dice many times and then just looking what are going to be the outcome of random events. And then we plot the pair volatility, but also tile events. So we see what's going to happen if Bitcoin, for example, drops 30%, or like a specific asset is going to appreciate 80%. We also saw those kind of moments. In example, when Comp was listed on Upbit, I believe it appreciated like 70% within a couple of hours, which was naturally an anomaly. But as an oracle on the Redstone side, we had to keep posting that kind of price feed on-chain. And also what's the collateral default probability. And then we plot within the simulations the probabilities that a certain position is going to breach the loan to value trigger and get liquidated. This year is a year of vaults, and a vault is simply an on-chain equivalent of an investment vehicle that provides exposure to a defined strategy. Investors deposit an asset, often stablecoin, and receive a receipt token that represent pro rata claim on the pool, similar to fund units. So it's very similar to how BlackRock and many other people operate. So you can imagine there is a curator, there is a vault, and the curator allocates the money that people put into specific stable coins, into specific yield strategies, into specific markets, and then we are able to rate the whole vault based on all the composition of the strategies that are put inside and managed actively. It's not just theory, it's life. So we've got over $10 billion rated, over 125 volts on Morpho and the coverage of 90%, over 55 assets rated, 250 Morpho markets, and 100% coverage of Spark, which is one of the largest lending market in the space. And in practice, I mean, I talk about ratings, okay, nice, there's the letter, DA, and whatever, but if you go to Morpho app right now, app.morpho.com, I believe, or IO, and you check out the vaults over there, you can go to specific ones like Gauntlet USDC, Stakehouse USDT. Okay, that's supposed to be a video, but it works as a as a picture. So unfortunately, video is not going to play. But if you go to a specific vault on Morpho right now, and you see an APY of, for example, 3%, you can go to the risk section and see exactly what's going to be the rating allocated to that particular vault. And what we are working with Morpho right now is to display the rating over here so that you have both the APY and the risk rating next to each other. And then you can try to calculate new metrics, such as, for example, risk-adjusted return, right? Given the rating and how it's been behaving in the past, and also the APY, you can create an allocation that works for you the best. Another example is also Spark. Unfortunately, it's also a video that's not playing. So essentially, if you go to app.spark.com right now, and you check out the Spark saving product, USDC is yielding 3.75 APY. You check out the risk rating tab, you're going to see that majority of the strategies over here got A- rating, which in general is a very good one. Like A rating means that something is extremely safe. A- is still like a very attractive one. B+ is starting to deteriorate, like going towards the more risky section. And an asset that recently got A+, which is like very unusual, is the staked ETH. So we looked into Lido and the history of the asset itself, how it's being operated, and we created a campaign with them to showcase that they are assets that are very well, with a very good track history and low risk associated with the investment strategy. Okay, so I can talk and talk, but what's the difference with the rating? Well, so actually we looked into the data of the performance of specific vaults that were rated and unrated. So those are 2 vaults over Morpho that offered the same exposure to asset by 2 different curators. And the moment they got a rating, you can see that the TVL started to grow quicker. But even more important, in the moment of drawdown, we see that less people exit their position. So they are less afraid that something bad is going to happen there. And they're also allocating less, I would call them tourists or a mercenary capital that just go after the airdrop hunting. And I really appreciate that you all came to the presentation. So I'm also happy to share an alpha that we are launching next week. So those ratings so far have been present on the protocol level. So you could go to specific websites. But what's going to be the most useful for individual users is actually a platform that aggregates all the positions that you can allocate into in DeFi together with ratings and the APY associated. So in the Credora platform that we are releasing next week, you're going to see vaults, markets, curators, and assets, and you can compare them. So you can try to even simulate a portfolio if you're deciding to allocate into specific areas, and then compare them before you're actually executing the strategy. We have wallet rating feature where you can just plug into your wallet. We are going to analyze the positions that you have active on the wallet and get an information about the rating of your particular holdings. And the most important feature after last weekend is going to be the last one over here, alerts. So we are going to expose an API that will inform users if a rating of a specific asset is going to deteriorate, because it's not just static, you just put it out there. It's being monitored constantly. So with Resolve, we were able to spot that something was happening with the hack only after a few minutes it happened. So it would give many of the users the possibility to exit quicker, because the Resolve team specifically took 4 hours to do a public announcement and identify the issue. What comes next? So builders are going to create new products on top of those ratings. For example, insurance, programmatic strategies, AI agents will utilize the ratings to define the strategies they are going to allocate into, and new lending protocol designs. Thank you very much, and if anyone wants to chat more, I'm going to be outside. Cheers.